The US dollar has been the undisputed king of global finance since World War II. For decades, this power was based on trust and economic might. But in 2022, a seismic shift occurred. When Russia invaded Ukraine, the US and its allies didn't just send weapons. They unleashed a financial bomb. They froze Russia's central bank reserves, hundreds of billions of dollars. The message was clear. The dollar is no longer just a currency, it's a weapon. And the world took notice. Nations started asking a dangerous question. If they can do it to Russia, can they do it to us? That's a huge problem, because when countries lose faith in the dollar, they start looking for alternatives. And when the world's piggy bank is no longer seen as safe, the entire global financial system starts to crack. Result? A new Cold War, fought not with missiles, but with money. Inflation is not just about printing money. It's about trust. The dollar's value comes from global demand. Everyone needs dollars to buy oil, to trade, to invest. This constant demand keeps the dollar strong and our import prices low. We can run massive deficits because we know the world will always buy our debt. It's been called our exorbitant privilege. But what happens when that trust evaporates? When nations actively seek to get out of the dollar, demand falls. The value of the dollar drops, and all those trillions of dollars held overseas have nowhere to go but home. They come flooding back into the US economy, chasing the same amount of goods and services. This isn't your normal inflation. This is a system shock. Suddenly, the price of everything imported, from electronics to clothes to coffee, skyrockets. The cost of borrowing explodes. The foundation of the American economy, built on a strong dollar, begins to crumble. This weaponization has a blowback effect, and it's aimed directly at the American consumer's wallet. Let's rewind. After World War II, the Bretton Woods Agreement made the dollar the world's reserve currency, pegged to gold. It was a symbol of stability. In the 1970s, that link to gold was severed, but the dollar found a new anchor: oil. The Petrodollar system ensured global demand for greenbacks. Throughout the Cold War, the dollar was a tool of influence, a symbol of American power and prosperity. Sanctions were used, but they were targeted, like a scalpel. But in the 21st century, the strategy changed. After 9/11, the US began using the financial system more aggressively, cutting off terror networks and rogue states from the global banking system. The dollar became a tool of coercion. The sanctions on Iran were a prime example, crippling their economy by locking them out of the dollar-denominated world. It was effective, but it also showed everyone the raw power the US held over the global financial plumbing. Each time the weapon was used, it made other countries nervous. Now we're in a new era. The freezing of Russia's assets wasn't a scalpel, it was a sledgehammer. It crossed a red line. For the first time, a major G20 economy's central bank reserves were simply switched off. This action sent a shockwave through the world. China, Saudi Arabia, and even traditional allies started to rethink their reliance on the US financial system. The response has been swift. China is aggressively pushing its digital yuan for international trade. Saudi Arabia is now openly discussing selling oil to China in yuan, a direct threat to the petrodollar. BRICS nations are developing their own payment systems and a potential new reserve currency to bypass the dollar entirely. This isn't just talk, it's a coordinated effort to build a parallel financial universe, one where the US can't just flip a switch. We are witnessing the birth of a multipolar currency world, a direct consequence of the dollar being used as a weapon of war. So what does this mean for your 401k? The stock market loves stability. It thrives on predictability and the free flow of capital. But this new financial Cold War introduces massive uncertainty. A declining dollar could, in the short term, make US exports cheaper and boost the overseas profits of multinational corporations. But the long-term picture is far darker. Imagine a world where foreign investors start dumping US Treasury bonds. Interest rates would have to soar to attract new buyers, crushing the bond market and making government debt unsustainable. This would trigger a recession. A massive influx of dollars returning to the US would create hyperinflation, destroying savings and corporate profits. The stock market, faced with soaring costs, falling consumer demand, and a volatile currency, would face a historic reckoning. The exorbitant privilege that has propped up US asset prices for decades would be gone. Finance is built on a simple premise: your money is safe. The weaponization of the dollar has shattered that illusion. Central banks are no longer just managing inflation. They are now managing geopolitical risk. They are diversifying their reserves, buying record amounts of gold, an asset that no government can freeze or devalue with a keystroke. This is a defensive move against the perceived risk of the US financial system. The very architecture of globalization, built on the dollar, is being rewired. Supply chains will be rerouted. Trading blocks will solidify. A financial iron curtain is descending. When the ultimate safe haven asset is no longer perceived as safe, it forces a complete re-evaluation of risk everywhere. And when the foundation of global finance cracks, the entire structure is at risk of collapse. Result? A financial world war with your savings caught in the crossfire.